Dan, not to socially stereotype, but you don't look like a financial expert.
That's fine.
You're young. You have a very cool moustache.
Thank you
You
very
kind of
much.
look like a singer songwriter type,
Mm.
but you are, and you've been in this business for quite some time. So I often think about you because you write for us as well, and I'm always thinking, when did you get into this, and how do you compare it to your friends?
Yeah, it's funny. I mean, I suppose I kind of very much ended up in this profession almost by mistake. Like a lot of other people, when I was doing my CAO way back when I was in secondary school, I hadn't a clue what I wanted to do. Just ended up picking business and finance in UCD because it was broad. Ended up falling in love with all things accountancy, taxation, and finance. Ultimately, ended up going on to do a master's and spent some time in financial services as well, and got the professional qualifications in accountancy, tax, and financial advice. So this was like never really the plan. It was just, I suppose, I love learning and I loved the ways in which financial concepts were presented by my lecturers, and I kind of fell in love with the idea of learning as much as I could about this topic, and then later specifically, you know, sharing that knowledge with people who didn't have access to it. Because, you know, you mentioned I probably don't look like a stereotypical financial advisor, but I'm very fortunate to have the information that I have at my disposal. Whereas, you know, a lot of my friends and peers and even people who are younger than me and older than me don't have access to that information. So I decided early on that I wanted to share this with as much people as I could, because I feel specifically in Ireland, you know, the powers that be who are responsible for educating the people of Ireland aren't really doing a good enough job. Specifically, you know, the CCPC, the Central Bank of Ireland, and the government, in terms of financial education and their financial literacy programs, they could be doing a lot more. I know we have things like, you know, the National Financial Literacy program, the 5-year plan, and things like that. But how I see it is the people who are responsible for these financial education programs in Ireland are a bit disconnected from the way in which people have a tendency to consume this information and want to consume this information, specifically young people. And I think the way that we teach financial education in this country needs to be adapted for the modern age. And that's effectively why I got into making videos online on YouTube from my bedroom, you know. And, you know, I would argue that over the last 4 or 5 years that I've been doing that, I've probably outputted, you know, more educational financial literacy, personal finance content, you know, with just a 20-euro webcam and a microphone than a lot of the teams that are meant to be responsible for this in the country. And I don't take pride in saying that. I wish it was the other way around. But I think, you know, the reason why a lot of people don't have access to this information is because the systems that are meant to give it to them have ultimately failed. And I think, you know, 3 great examples of that in my head that come to mind, you know, number one, pensions, right? We have a massive state pension crisis in the fact that we have a rapidly aging population. By 2050, there's going to be twice as many people in retirement drawing down the state pension. And people need to be engaging with their pension early and often. And things like, you know, auto enrollment and stuff like that, in my opinion, they're bandaged solutions. They're not really the way that we need to go. But yet, aside from all of that, you walk outside this building and you ask the average person, you know, what is a pension? You're going to get 50 different answers. Very few of them are actually going to be correct. So that's one way in which, you know, I suppose the system has failed, because pensions are so fundamentally important, both from a tax perspective and tax saving perspective, but also preparing for the future. The other one is, you know, Ireland as a nation is literally a global leader in terms of exchange traded funds, index funds. Statistically, over the last 100 years worth of data, the best way to invest. And all the best funds and fund managers choose to set up in Ireland because we're the best location to have these products. But yet we have a population that is totally estranged from ETF investing and knowing what that is and why it's a good thing. And on top of that then as well, you know, you have government policies and taxation policies that tax the living daylights out of ETF investment returns. You know, it was 41%, it's gone down to 38%. It should ideally be aligned with CGT, capital gains tax at 33%. And then you also have deemed disposal, which taxes the gains on those investments every 8 years, regardless of if you sell. 86% of Irish household deposits, 140 billion quid, is just completely sitting idle in either Irish current accounts or Irish demand deposit accounts, earning an average rate of 0.13%.
Why are we a nation of savers, would you say? What are the factors driving us to save rather than to invest?
Traditionally, you were always taught that like the best place for your cash is a bank account. And, maybe you would engage with your pension a bit as well. But for the most part, people are told that like, cash is king, keep the cash where you know where it is, keep it in the bank account, and that's fine. Don't really explore beyond that. But the problem with that logic is that it just doesn't work. It's not beneficial for, your financial well-being, your financial independence, for the sole reason that, as I said there, 0.13% is the average rate offered on Irish bank accounts and current accounts. Now, the fact of the matter is that's before tax. So after tax, it's actually more like 0.09%. And the biggest problem with that, above all else, is the medium-term annual average inflation rate expectation set by the ECB for the euro area, which includes Ireland, is 2%. So you can imagine that the average Irish person who's keeping the vast majority of their cash in a current account or a demand deposit account with one of the three Irish banks is earning whatever 0.09% on average on their savings, but they're losing 2% to inflation. So actually, their net return every year, they're losing 1.91% on average every single year on their savings. What does that actually mean? Well, theoretically, if you had €10,000 sitting in an Irish bank account earning that average rate of 0.13%, after 10 years, that would buy you about €8,200 worth of goods.
Do you think that message is out there? Do you think the average person on the street understands that their money is losing value?
No, definitely not. And I think it's, inflation really is the silent killer. And I think it's because, it's a very real thing, but we don't see it directly in our bank account, in the sense that, our bank account balance isn't declining as inflation ticks away yet. Technically it is when you go and you spend things and things become more expensive, and then all of a sudden you've less money in your account. But because it's not like a direct deduction, you can see inflation effect in your bank account, people just aren't aware of it. And like, the fundamental reason why you want to choose savings accounts that help you earn more interest, or the reason why you want to start a pension early and often, or the reason why you want to invest in index funds, at a minimum, is to protect your money from the effects of inflation, right? And that's the fundamental principle. But the question, I suppose, that's more important to answer is, why are the rates low in Ireland? Why is the average rate 0.13%? And why do so many people, keep so much cash there? And I think when you're looking at that, there's a couple of things to say on it. I think it's very easy to take the narrative that like, the banks are just really greedy and, they don't want to pay a fair interest rate and all that kind of stuff. And I don't really think that narrative does any service to actually solving the problem or coming to a reasonable solution. I think, the fact of the matter is, first of all, you have to look at banking psychology, right? And you have to look at how does banking work, not only in Ireland, but in the US and globally. And all the research papers show us that banks have significant control over the deposit rates that they set for customers, right? That's a fact. And a lot of the times, banks know that they can get away with keeping rates low or not competitive or not passing on increases in rates to customers, because they know that customers very seldom change banks to get a better rate. The second point is, Ireland is a bit of an outlier in the sense that we only have really three main retail banks, right? AIB, Bank of Ireland, PTSB. And, when KBC and Ulster Bank left the Irish market, the Central Bank of Ireland published a report that clearly said that the move from 5 retail banks to 3 could present a really great opportunity for the Irish banks to increase their profitability and their profit margins. And that's exactly what happened. The other side of it is terms, conditions and fees. Probably the thing that is talked about less often when it comes to the Irish banks. On the terms, conditions side of things, yes, it is true that the Irish banks have certain accounts that, advertise 2 to 3% interest rates, right? Which at face value looks great. This could be a competitive account. Maybe I'll give it a shot. The problem is with a lot of these accounts is they are what the Irish banks called regular savers accounts. And effectively, they advertise a high interest rate. But the problem is they put a very low maximum monthly deposit on those accounts. So yes, you can earn 2%, 3% interest, but actually you can only deposit £1,000 a month, £2,000 a month, whatever it might be. And, for a lump sum saver, for someone who has 10, 20, 30 grand ready to deposit now, that's totally useless because, if you were restricted to €1,000 a month and you had 20 grand ready today, it would take you 20 months to get the cash into the account. Meanwhile, the rest of your cash is just sitting idle there waiting for it to be deposited.
So what are the alternatives for the lump sum saver who wants to get more bang for their buck?
The most competitive options for savings accounts right now are in Europe. So you have to look outside of Ireland. You have to look outside of the Irish accounts if you actually want to earn competitive interest rates, right? There are two, I suppose, subsections of accounts. There's instant access accounts where you can access your money instantly. You can withdraw whenever you like. And then there's fixed term deposit accounts where you get a guaranteed fixed interest rate on your savings, but you commit to locking them away, locking your savings away for a predetermined period of time. It can be as short as 3 months to as long as 7 years, depending on the account. So what we're seeing in our analysis is, roughly speaking, you can pretty comfortably get a 2% AER interest rate on an instant access account with a variety of European banks, right? That's 15 times the average Irish rate of 0.13%. So significantly more interest available. On top of that, a lot of these accounts, the vast majority, don't have fees, and you can deposit lump sums, as you were saying there, into it without hassle. So if I'm someone with 20, 30 grand and I want to deposit it now and I see a 2% account, in most cases, these European accounts will let me just deposit that full 30 grand straight in, no messing. That's how it works, right? The other side of it is for the fixed term accounts, again, what we're seeing is from 3 months all the way up to 7 years, the Irish bank equivalents are completely outclassed by the fixed term accounts that are offered by European banks. And again, we're seeing rates as high as 3.05%. On longer term products like 7 years, but you could even get 2.8% plus on a 2-year or a 3-year product as well. So the alternatives are definitely there, and I think the biggest question mark that people always have about them, and I think it's a misconception, is the question of safety, right?
Yeah.
So people always just assume that the Irish banks are tried, tested, and safe. And anything that is new and not the Irish banks has a question mark over it, right? And a lot of that, in my experience, comes down to familiarity bias. You favor what's familiar and you kind of fear the unknown. But there's a lot of misconceptions and misunderstandings about what European banks are and how they operate, right? First point, every single bank in the European Union, including the Irish banks, is covered by what's known as the Deposit Guarantee Scheme, right? This is an EU directive that's applied across every Euro area country that says that each EU member state has to guarantee the deposits of its banks up to €100,000 per customer per bank, right? So what does that mean? Well, that means if I save 50k in Germany with a German bank, the German state is guaranteeing me that if anything should happen to that bank, they will return my full deposit to me within 7 working days of that bank failing, right? So you can get your money back faster than you could get some of your online shopping deliveries, right? So it does not matter what country it is. It doesn't matter if it's Ireland. It doesn't matter if it's Germany. It doesn't matter if it's Lithuania, Malta. All these banks, provided they're regulated, of course, are protected up to €100,000, okay? And I think there's a tendency for people to say, oh, well, yeah, okay, yeah, I know that rule exists, but surely the Irish scheme must be more safe than the German scheme. It's just not the case, right? This is an unconditional guarantee by each European member state that your money has to be protected, has to be. And there's a ton of provisions in place in terms of, you have European banks pay contributions into what's called a deposit guarantee fund to effectively prepare for a scenario where a bank in their network goes down and they have to recoup the cost to the depositors. And then even if the money in that fund is insufficient, it's completely guaranteed by alternative financing means, which effectively just means that the state will cover the cost. So without a doubt, if there's one thing that you take away from this, is the same protections that apply to Irish banks also apply to European banks as well. And that's the more obvious protection. But the second point that I would bring up, and it's probably the point that's talked about less, is the fact that these banks are regulated, right? They have a banking license in the first place. It cannot be overstated, I suppose, how difficult it is to do that, right? Getting a banking license, getting regulated off any central bank in Europe is an incredibly tough task, right? You have to go through really, really strict provisions around, the founding team, the qualifications, the systems that you have in place. Everything is absolutely scrutinized to make sure that you are a proper and safe entity that the European Union is willing to put into the financial ecosystem. And the reason why it's such an important factor to consider is because in Europe we have this thing called passporting, where if any central bank, if any member state regulates a bank and gives it a banking license, that bank is then free to passport or move its business into other member states freely, right? So if the German regulator approves a German bank, that bank can then come here and operate. So every regulator owes it to all of the other regulators to make sure that they're carrying out that process effectively and really making sure that the banks are safe. And then on an ongoing basis, the banks have to meet capital requirements, and they're subject to really strict financial oversight as well. So
maybe the risk, though, Dan, is only making 2% on your money.
Yeah.
Because our colleague Owen McGee, in his columns, he's always saying, if you don't need the money in the next 5 years, it doesn't belong in a bank account. It needs to be invested. Do you have any take on that?
Yeah, for sure. I mean, look, I think the point is trying to, first of all, establish what we're trying to do here, right? We're not trying to say that anyone is going to secure financial independence or get really wealthy by, using a high yield savings account, right? That's not the case at all. This is a mindset shift, right? The point is, better accounts exist, so why not use them, right? Regardless of the actual monetary outcome, even though they are significant, right? This is significant extra interest that you can earn by using European accounts. If I was to say 4 things that people should do to achieve, financial literacy or financial independence, number 1, pump the pension as much as possible, right? You want to maximize personal contributions to a pension scheme as early as you can.
How young is young, by the way? Because I'm always curious, first of all, when did you start?
Yeah.
And secondly, in an ideal world, what would you say is the best age to start your pension?
Yeah, I think, look, the short answer is there's never really too young of an age. I genuinely believe, I always tell people, when you're looking at specifically for pensions, the thing I always talk about is, if you can go into, your first proper job or whatever job is paying you a decent salary, with the mindset that, okay, whatever my gross salary is, I'm going to account for a pension contribution of X, right? And that's going to be a non-negotiable insofar as possible. What happens then is, you kind of secure that ability to contribute early to your pension, but you also build your lifestyle around that lower salary. Whereas it's much harder later on to, if you haven't contributed to a pension ever and you've built a lifestyle around, your gross salary, and then you have all of your various ranges of expenses, but you've never accounted for a pension, it's much more difficult to go backwards. So that's why I say it's always better to start early and build in the habit from a young age. In terms of when I started, I started first investing in 2017. is when I really started getting involved in it, and that's kind of when I started my
The early 20s.
but even that for me was still a bit late. And that kind of just shows to me the work that has to be done. Because, even though I came from a business and finance background, and even though I came from the academic side of things, theoretically I could have still started it earlier. And I probably would have been able to do it.
I'm sorry, the four things.
Yeah, so we're back to the four things. So the pension is the first one, but I would say beyond that, if you have kind of excess cash at the end of the month, even after contributing and maxing out your pension contributions, if you still have excess cash that you'd like to invest, well, that's when you look to things like personal investments, and you start looking at, okay, can I open a low-cost brokerage platform, of which there are many operating here nowadays. And you do that, you commit to it, whatever investment schedule you can, and you just try to invest consistently for decades, right? We're not talking about like, I'm going to invest for a year or two and see what happens, I'm going to make $1 million. It's not the case, right? This is a long-term game. So both your pension and your personal investments are centered towards long-term activities. And then on top of that, then for point number 3, you go a step further and you say, okay, for the cash that I do have to hold, be it for an emergency fund, maybe I'm saving for a wedding, home renovation, I'm saving for a home, maybe I'm self-employed and I'm saving for my tax bill, whatever it is. If we're going to have, a high amount of cash in the bank account, we need to ensure that that cash is going as far as it can. And you need to look to these European alternatives, of which there are many as well. Just to name a few, we have Moco, who just started recently operating in Ireland, which are offering a fantastic account. We have Raisin, so Raisin Ireland, a savings marketplace that gives you access to over 30 plus European accounts. We have Trade Republic, offering a 2% interest account, fully regulated. And then for people who want to experiment with like money market funds and investment structures that are cash related or akin to cash, but technically an investment, you have things like Trading 212. So you can get like 2.2% on your instant access savings with the downside of less protections because it's technically an investment and not a deposit. So, there's a ton of options out there. And those are the 3 main things you can do from a investment and asset allocation perspective. And then thing number 4 would just be, insofar as possible, stay away from expensive short-term debt, right? Mm-hmm. And if you do those things, you talk about like a 5-year financial literacy plan imposed by the government. That's all you need to know. And I tell people that all the time, is that like, I've spent the last 5 years making videos on YouTube and, whatever, I've produced over 300 videos at this point, and people are always like, what are just the main things I need to know? And I always tell them is that like, if you just maximize your pension contributions and invest in index funds and make sure that whatever cash you have is in a high interest savings account, you'll be fine.
What about the neobanks? Like, are they competitive, like the likes of Revolut, Bunk, and by which I mean for like a high yield savings account?
Yes and no. I mean, look, I think the neobanks are competing on a variety of different factors, right? They're competing as a banking product. They're competing as an alternative current account to the Irish banks. And so they offer a multitude of things. Interest is part of those things, but yourself at Revolut, like they have a vast array of different perks and benefits you can get depending on what tier you're in, and Bunk do something similar. N26 we'll soon have Monzo here as well. So there's a lot of neobanks operating in the space. But from an interest perspective, I would say no, they're definitely not the most competitive. If you're asking me today, what are the most competitive instant access accounts for Irish savers to consider right now, I would say number 1, Trading 212, with the caveat that it's a money market fund, not a deposit structure. So there's extra considerations there around the protections. Number 2, I would say Raisin Bank and the instant access accounts that are on there. They are all covered by the deposit guarantee scheme. And then I would say number 3, Moco. They'd be the 3 from the instant access perspective. And then from the fixed term perspective, I'm fairly sure every single account in the top 10 is all hosted on Raisin Bank or on Raisin Ireland. So the neobanks, while they are definitely competitive from a banking perspective, I think from a savings perspective, there's better options elsewhere. And that's also one of the primary reasons why I've built a new website that I've been working on as well, Honest.ie, is because, having talked about this for years, what I realized is that, there's no single one transparent, trusted source where people can just go on and see, number 1, really high quality comprehensive yet easy to understand financial guides that tell you the most important things that you need to know without the jargon and without the complexity. And number two, a really slick and good looking product comparison tool that shows you all the pertinent details, highlights any kind of sneaky terms and conditions, fees, anything that you might want to consider. There was nothing like that. No website like that existed. And so in addition to having all the stuff that I do over on YouTube, I wanted to kind of bring that to life in a website form. And so, you know, we've just launched with our savings section. But savings is just the beginning for this. You know, as I said there, savings is just one very small piece of the overall financial independence puzzle. And, you know, we're going to be moving on to banking. So again, looking at things like the neobanks and how they stack up against Irish banks from a current account perspective and a transaction perspective. We'll also look at investments. So we'll look at things like the best brokerage accounts where you can invest cash, and we'll talk about like the best kind of ETFs and how to compare ETFs and find what one's right for you and different investment strategies. And then we can go really deep into things like pensions and taxation and all that kind of good stuff. So I really want to create, you know, one single holistic place where someone can come with the comfort of knowing that, you know, the content has been written by someone who is A, qualified, but B, has no ulterior motives other than sharing the information that's important with Irish people and ensuring that every Irish household has the information and guidance that they need to make informed decisions.
So we've talked a lot about where to save, where to get the best savings rates, but let's just get back to basics here, you know, how to save and savings rates, you know, at a personal level. There's this like 50, 30, 20 rule. There's lots of different rules. What would you say is a good percentage of your take-home pay to try to save each month?
Honestly, and it might not be the answer that people want to hear, but I genuinely believe it fully depends on the person, right? And it's the same thing with like the emergency fund concept of like, oh, you should save 3 to 6 months worth of expenses. And you have all of these rule of thumbs, and like rule of thumbs are fine, but ultimately, you know, even something like an emergency fund, the question is, how much do you actually need to have in the account to sleep well at night, right? You know, how much, and to answer your question, if you're talking about like, well, how much should you be saving? It's like, well, like what can you reasonably do now without putting yourself into misery, you know? Like that's not the goal here. Like the point of life is for living, right? And, you know, are some people off track or not on course for financial independence? Absolutely. Could people be doing more? Undoubtedly. But you have to kind of take it one step at a time. And that's why I've always been very much a principles-based kind of person. Like I love teaching people about the principles of what's important, and then how they go about executing or achieving or putting those principles into practice is ultimately up to them.
So it's like mindset shifts just compounding.
It's mindset, and it's also culture, right? I think this is the number one thing that we need to get better at as a country and as a people. And I think that comes with, you know, just keeping the conversations going, is that we don't really have a culture, a financial culture, an investing culture in this country yet. Like it does exist. There's absolutely pockets of the internet, and there's pockets of Reddit, and you know, online forums, and there's WhatsApp groups and stuff where people talk about this stuff. But it's still very much kind of like taboo, not talked about, a little bit awkward if someone brings up money. And really, you need to have, it has to be a shared experience. People have to be sharing their perspectives and their learning experiences with other people, because ultimately, you know, if we're just not talking about this and information is gate kept, and you know, people aren't sharing honest experiences, we're just going to be trapped in the same old, and absolutely kind of nothing grows there. You know, nothing grows in the comfort zone. So a big mission of mine and a big mission of Honest is always just like keeping the conversation going and making people aware that, like, you know, they are their own individual person and their own individual circumstances matter. And I think the best way of considering their circumstances is to understand the principles of what they could or should be doing, and then adjusting their behavior in whatever way they see fit to those principles to just try do a little better day by day. That's all you got to do.
So Dan Malone, the new platform is called Honest.ie.
Yep.
Thank you so much for joining us.
Thanks very much, Katie. Cheers.